What's going on, everyone? Welcome back to Cash Flows. My name is Wallace, and today I'm going to be covering Apple's 4-to-1 stock split that I mentioned in one of my earlier posts on Instagram. So as I said, Apple did mention that they're going to be doing a 4-to-1 stock split when they released their earnings for Q2 last week. So I'm going to cover exactly what that is, why companies choose to do it, and what that really means for the investors that are already invested into Apple and the ones that want to invest into Apple in the future. So with that being said, let's get right into it. First thing I figured, let's just cover exactly what a stock split is. A stock split is when a company chooses to create more shares of the company by lowering their share price. So like I said, Apple's doing a 4-to-1 stock split. That means they're gonna divide their stock price by 4 and create 4 times as many more stocks that they already have in the market. So right now, Apple's stock price is about $440 per share. So that means their stock price after August 31st is gonna be about $110 per share. This is not the first time that Apple's done this. This is actually gonna be the 5th time that Apple's done a stock split. The most recent one that they did was back in 2014, and it was actually a 7-to-1 stock split. So after their stock split, it was about $100 per share, and they created 7 times as many stocks that they already had back then. Now, it's normally common to see companies do 2-to-1 stock splits, but Apple's been on such a long growth run that their stock price has gone through the roof very quickly. So they need to split their stocks a little bit more quicker than the average company. So let me give you an example of what exactly a stock split does, but I'm gonna use cash instead. So think of a $100 bill being split into 2 $50 bills. So it still amounts to the same $100 in value, but now instead of one bill, you have 2 separate $50 bills. So that's essentially what a stock split is. You're just creating more notes or more shares, but also decreasing the value per share. So the question now is, why do companies choose to do stock splits? And there's a few reasons why they do that. Now, one of the main reasons why companies choose to do stock splits is to make their stock price look more attractive to retail investors such as myself and yourself. To the average consumer, we still do look at prices and the nominal dollar value of things that we're buying. Although the 4-to-1 split kind of retains the same value when you have the $100 stock price, but 4 times more stocks, at the same time, that does look more attractive to investors. So that kind of does make them more susceptible to want to invest into Apple. Now, another reason why companies choose to do stock splits is because it allows smaller investors to actually invest into their companies. Let's say the stock that you want to buy is $20 per share, but you only have $10 to invest. If that company were to do a 4-to-1 stock split, that means each share would be worth or valued at $5 per share. That would allow the investor with $10 to actually buy 2 shares of that company, which they weren't able to invest into the company at all when the share price was $20. So that's what I mean by it allows smaller investors to invest into companies that have had some real good growth over the past few years. Once you allow smaller investors, that allows more people to actually invest into your company. And as more money is flooding into that particular stock, that does push the share price up further where it was before as well. So those are the 2 main reasons why companies choose to do stock splits. But what does that mean for the investor and their dividends and their shares, the amount of shares that they already have? Not much will really change in terms of what the value of your account is, but you will see a small differences in what your account setup looks like. So let's say you had 20 shares of Apple at $400 a share before the stock split. After the stock split, the share price will go from $400 to about $100 per share. But then you would also have not 20 shares, you would have 80 shares. You just have more shares and they're worth less per share. So not much will change for investors that are already invested into Apple. But one pattern that we do see when companies do stock splits is that their company continues to grow after the stock split. Why? Because you just allowed a lot more investors into your market. You've allowed a lot more people to invest into your company. And usually investors do start with small amounts of money. That's gonna open a gate for a lot of new investors to invest into Apple. Now, some companies that I do feel like should do stock splits, definitely Amazon. Like, their stock price right now is about $3,300 per share. I easily feel like they could do a 30-to-1 stock split or even like a 10-to-1 stock split. Think about that. You need to have at least $3,000 US to be able to invest into Amazon. But if Amazon were to do a stock split where their share price were to go under $1,000 per share, I'm sure there'd be a ton of new investors into their share, because right now, like I said, the price is kind of crazy. I feel like could do a stock split is Tesla. Tesla's shares are about $1,500 per share right now, but it may be too expensive for a lot of small investors to get in at a $1,500 US per share price range. if they did like a 3-to-1 or a 5-to-1 stock split, you'd be able to enter into Tesla at like $300 per share, which would open the gate for a lot of new smaller investors once again. So those are just a couple companies that I feel like should and could do a stock split. So that's pretty much it. Once again, thank you for watching my videos. Please don't forget to like, comment, share, and subscribe to my channel. And if you do have any other video ideas that you want to share with me, that you want me to cover or go over, please do let me know. And as always, thank you for watching.